Now, coming to the history of insurance, the first company that came into existence as far as insurance business is concerned is LIC of India, that is Life Insurance Corporation of India, which was formed in the year 1956 after nationalization of life insurance business of 245 private insurance companies. So all the 245 insurance companies came together after nationalization, after the nationalization of insurance business. LIC of India was formed. Then the general insurance business of 107 insurance companies was nationalized in the year 1972, and 4 public sector general insurance companies came into existence. So that is what is the history of insurance. Now the classes of insurance are life insurance and general insurance. So basically we have 2 categories of insurance, one is life and one is non-life, which is called as general insurance. Under general insurance we have further classifications which is fire insurance, marine insurance and miscellaneous insurance. So under miscellaneous insurances we have motor insurance, that is vehicle insurance, trying to protect the vehicle, then mediclaim insurance, as we have already talked about, reimbursement of any medical expenses, then householders insurance in case of any burglary, any theft, any fire taking place in the house. If such an insurance, such a loss has to be protected, it is done through a household insurance. Then shopkeepers insurance, if they would like to protect their stock, right, their the shop. In such cases, under miscellaneous insurance, they can have a shopkeeper's insurance. And then engineering insurances, any projects which a company is coming up with, if they'd like to protect that project from any unforeseen circumstances, then they can go for engineering insurances. Now friends, there are certain fundamental principles of insurance which we always need to keep in mind. Now firstly, the foremost principle which we have already talked about is the insurable interest, means financial interest. As I said, there has to be an insurable interest for the insurer, right? For the insurer there has to be a financial interest in the property, because in case of any eventuality, any loss that occurs to that property, there has to be a huge loss to the insurer. Then utmost good faith, that is greater duties of faith on proposer and insurer. So as we say, this is a lawful contract. When we talk about a lawful contract, there has to be utmost good faith. So the person, the proposer who is going to make an offer, right, the insured, that is the one who is going to be insured, the proposer needs to give he has to disclose all the facts to the insurance company or to the insurer in length, so that there is always the utmost good faith which is kept intact in case of insurance contract. Then the fundamental principle which is very important in insurance is indemnity. So indemnity is talking about the actual compensation of loss. So what happens is, when I talk about the compensation coming in from the insurance company to the insured, let's say he has incurred a loss of 2 lakh of rupees. Right? So when I talk about the insured who has incurred a loss of 2 lakh of rupees which was insured or which was covered by the insurance company, the compensation has to be maximum to the extent of 2 lakh only. It cannot go beyond that. It is not possible that I incur a loss of 2 lakh and the insurance company gives me a cover or it gives me a reimbursement of 4 lakh of rupees, right? So it is giving me 4 lakhs, wherein the loss which I have actually incurred is just 2 lakhs. So the indemnity talks about making good the loss. So whatever is the loss, only that amount has to be compensated. Next is subrogation, that is transfer of rights of the insured to the insurer. So what happens is, under the principle of subrogation, the insurance company or the insurer gets the right on the property from the insured. That is the principle of subrogation. Why? Because he is the one who is going to actually now make good the loss. That is the reason he has an insurable interest in that property. Then the fundamental principle, the last one, is the principle of contribution. Now what is contribution? It is talking about sharing of losses by all the insurers. Now let's say there is an insured who has taken policies from 3 different insurance companies. So there are 3 different insurance companies who have protected the life of Mr. A, right? Now when there is 3 insurance companies who have protected this life, in case of any uncertain death of Mr. A, all the 3 insurance companies are going to compensate proportionately. That is what is the principle of contribution talking about. It is not that only one insurance company says, okay, I will just compensate to Mr. A. No, it has to come from all the 3 insurance companies. So everyone is going to proportionately contribute for fulfilling the claim. Now friends, what happened is when we talk about insurance business coming up, gearing up in the Indian financial market, in the Indian financial system, there has to be a regulator, right? We need to have a regulator who is going to act as a watchdog to see if the insurance business is running properly, right? So what happens is, as I said, before IRDA came into existence, there was in the year 1999 when IRDA Act was passed. Before that, we had only 5 major insurance companies. One was life insurance. Under life insurance, we had LIC, Life Insurance Corporation of India, and under general insurance, as we said, there were 4 nationalized insurance companies, which were National Insurance Company Limited, New India Assurance Company Limited, Oriental Insurance Company Limited, and United India Insurance Company Limited. So, sorry. So they were basically, before IRDA Act, there were these 5 national players who were running the insurance business. But then the market scenario changed, right? With IRDA Act coming into the picture, with liberalization, privatization and globalization taking place, there was a lot of competition even in insurance business, which could be seen between the public sector and the private sector players. So the public sector players, as we said, they were the 5 major public sector players who were only running the insurance business before IRDA Act. Then came the private sector companies also, who gave a tough competition to these public sector companies, and that is the reason new innovation took place in the insurance business also. There were new products that came into existence which were more adapted, which were more suitable, more customized according to the requirements of the insurance of the insured. So there are various market intermediaries who came into existence. To definitely to procure the insurance business, it has to be channelized, it has to be routed through various intermediaries. Now, who are the intermediaries who were taking care of this insurance business? They were agents, right? Agents, as I said, even we can become an agent by getting the certification from IRDA. So if I am IRDA certified, I can also sell insurance policies. I can also enter into insurance business becoming an agent. Then there are corporate agents, right? Some companies, some broking houses, some financial institutions who are on their own becoming, who are running as a corporate agent into the insurance business. Then there are insurance brokers, and lastly we have the most important role that is right now being played is by the banks through the bancassurance channel. So coming to the basic life insurance policies, there are various types of policies under life insurance also, because depending on the requirement, depending on the objective of covering their life, even the individuals get different life insurance policies. Firstly, it's term assurance. Now, what is term assurance policy, friends? Here, it provides death cover only. So, I am getting a coverage. So, if I want to get the money, I want to get a claim settled under term assurance, I need to die. So, if I die, then only the money is going to come to me through a term assurance policy. So, it protects your death during the policy period. The premium is pretty low. Why? Because here there is no such bonus, no such returns which I can get through this policy. It is just safeguarding my life, right? So, throughout the life, I am protected with this term assurance policy, and in case of any eventuality, any uncertain death that takes place, they will compensate my nominee. There is no refund of premium, so it is as good as 1 year. Now let's say under term assurance, if I have taken a policy for 20 years, right? And I pay a premium. The premium is pretty low in case of term assurance policies. I pay premium on a yearly basis. So what happens is, I have taken it for 20 years, right? So first year when I pay the premium, let's say the premium is 2,000 rupees. Now that 2,000 premium has covered my life only for that year. So once the premium is paid, once the year is gone, the premium is also lost. So nothing is going to come back to me. It is as good as I have safeguarded my life with this 2,000 rupees. So term assurance doesn't return anything in the form of bonuses or any income. Then there is sum assured paid on death. As I said, in order to get the sum, the claim, I need to die under term assurance policy. Then there is whole life policy. The second type of policy, life insurance policy, is the whole life policy. Again, whole life, what does that mean? That entire life of mine is covered. Now here what happens is death cover, it is again a death cover. The period is not specified, as in term assurance where we specify the period for which I would like the insurance company to cover my life, right? In this case, we don't give any particular term, right? The entire life of mine, whether I'm going to live for another 20 years, 30 years, 40 years, whatever is the case, I am going to get the protection under whole life policy, okay? The premium is again very low because here also I don't get any bonuses, I don't get any returns. So the premium is low and it is paid during the lifetime. So till the time I survive, I am alive, I'm going to keep paying the premium and get the protection through the whole life policy. There is no refund of premium and the sum assured is purely paid on death. So the third category of life insurance is endowment assurance plan. Now here, yes, I can expect some returns that can come to me through this insurance policy. Now what it does is, it covers death and survival benefits. So if I survive after the tenure, let's say I have taken a cover for 20 years, after 20 years if I survive, I get some benefit out of this plan. So under endowment assurance plan, I will get some returns that will come to me, okay? So the sum assured is paid on death or on maturity of the policy. The period of the policy at the option of the proposer. So depending on my choice, on my requirement, I can decide for how long I would like to have this policy. So whether I want it for, I want a coverage of 20 years, I want a coverage of 30 years or 40 years, whatever is the case, it is my decision, the proposer's decision as to how long it will like to have this endowment assurance plan. It's the most common plan, friends, as on today. Why? Because everyone would like to get some survival benefit also. As under term assurance or whole life policy, I don't get any benefit. I don't get any survival benefit. But in case of endowment, even if I survive after the specified period for which the insurance policy was taken, if I survive, I get my all the accumulated premiums together come back to me along with some bonuses. Then there is one more important type of policy under life insurance, that is money back policy. Now what does money back policy do? It is available for different periods. So what happens is, now let's say depending on the requirement, let's say I'm an individual wherein I would, after 10 years, I need certain funds to for further education of my child, for the marriage of my daughter, whatever is the case. Now if I need funds in between during the period of my policy, I can go for money back policy. Now what money back policy will do is, if I have taken a policy for, let's say, 20 years. So this money back policy is going to return back my money after certain time intervals, right? So after certain time intervals, let's say after every 5 years, 5, 10, 15, after every 5 years, a certain sum of money will come back to me under money back policy. So it covers death and it also gives me a survival benefit. The lump sum is paid periodically. As I said, I don't get the whole amount after the maturity of the term. I get some money even in between the policy period. So the full sum assured is paid on death. So whatever is the sum assured, after paying in between in different intervals, whatever is left over and whatever is the sum assured, I am going to get it on the death. Now, the very important, in fact, nowadays when we talk about insurance, previously insurance was just a protection, a life cover, a cover for the risk. But today, the investors are taking it in the form of an investment. So today, we cannot say that insurance is just a protection, it is also coming up like an investment product. Now, what is the investment product under insurance? We have it in the form of ULIPs. Now, what does ULIP stand for? It is unit linked insurance policies, right? So, unit linked insurance policies is nothing but a blend of insurance as well as mutual funds. So, it is basically a blend wherein I am getting a protection, I am getting a life cover, but at the same time a major portion of my premium amount is being parked into certain investments where I can definitely get good returns. So, now ULIPs are giving me a blend of insurance as well as the investments. Each premium is split into units and the risk premium for life cover. So, now let us say if I am paying a premium of 1 lakh. So, under ULIPs what happens is, if I have taken a policy where the premium amount is 1 lakh per annum. So, what happens if the premium is rupees 1 lakh under a ULIP? Under a ULIP policy, unit linked insurance plan, as I said, the way in mutual funds we have a net asset value, even we have net asset value for the ULIPs. Why? Because even ULIPs are sold as units. Okay, friends? So, 1 lakh is the premium which I am going to pay on an annual basis. Out of this premium, a major portion of my premium amount is going to be routed to some investments, right? And there will be certain portion, leftover portion of the premium which will be used for my life cover. Okay, so out of this, it will be bifurcated into two halves, not two halves exactly, in fact major portion will go into investment, only a small amount will go for my life cover. Right. So, this is what is the basic feature. It is a blend of investment as well as life cover. They are priced as per the current market value. So, even in case of ULIPs, the NAV keeps on changing on a daily basis. Why? Because they are investing in the market. So, as per the movements that take place in the market, as per the prices that keep on changing in the market, the NAV of the ULIPs are also going to change. The sum assured and the current value of the units are paid on death as per the policy conditions. So, if let us say I have a policy under a ULIP, I have certain sum assured as well as if I have got certain units. So, there will be some units that will be allotted to me for that much amount, right. So, if I have taken a policy of let us say 5 lakh, the sum assured is 5 lakh, and on that basis I am going to be given certain units of the ULIP. And if the market performs well and the NAV goes high, my purchase NAV and my sales NAV on death, what will happen is, if the units, the NAV is going to be calculated, and whatever is the NAV on that particular day will come back to me as the investment return. So, I am going to get the money as a return on my investment. So, the current value of the unit will be paid on maturity. So, if I have taken a policy, a ULIP policy for 15 years, after 15 years, whatever is the unit value, I am going to get back the money on that basis. Then there is a pension plan, the most suitable for the senior citizens who doesn't have any other source of income. So, they would definitely like to have some regular income or regular money flowing into their pockets, so that they can take care of their day-to-day expenditure. Now, for that, the best suitable policy is the annuity plan or the pension plan. Now, what is the basic feature of a pension plan is, immediate annuity or deferred annuity starts at a specified age periodically, right. So, what I say is, now let us say I have taken a pension plan, till 10 years they are not going to pay me a single rupee, right. That is called as deferred annuity, postponing the annuity, okay. And after 10 years, every year there is certain amount that is going to come to me for taking care of my regular expenditure, right? So that is what is the basic feature of a annuity plan. It is a single premium paid for immediate annuity. If I, let's say, I want immediately the annuity to start from the next month itself, then in such a case, I can go for a single premium. I pay the premium, right? I pay a huge lump sum amount, and that amount will take care of my expenditure in the future. So on a regular basis, I'm going to get the funds through that annuity. Premium in installments paid for deferred annuity. Now what happens, as I said, deferred annuity, it is going to postpone the annuity for a certain period. So let's say 10 years is the period during which I'm not going to get anything out of this premium. So all the premiums are going to be accumulated. So all the premiums are going to be accumulated till this 10 years, and there will be some bonuses which I'm going to get, and on that basis then the annuity will start from the next subsequent year. So life cover also is a part and parcel of this pension plan. I get a life cover along with the annuities which I receive. Now what is the important aspect of insurance policies is the policies are available with or without bonus, right? As I said earlier, there are a variety of insurance policies which are available in the market. They might have a feature of bonus, or they might not have a feature of bonus. On that basis, the premium levels also keep changing. The death due to the accidents can be covered for additional sum assured. So I can, what I can do is I can pay a certain premium, an additional premium, to get some additional benefits, right? So I might get certain additional benefits over and above the sum assured by paying certain premium amount, certain additional premium amount. The policies are available exclusively for women and children. There are specifically certain policies which are meant only for the women and for the children, right? So there, so depending on the requirement, I can decide if I want to cover the, if I want to cover my child, I have separate policies which are available exclusively for them. Additional cover for major diseases are also available, and guaranteed bonus policies are also available. So these are the basic add-on features of life insurance policies which are there in the market.